Welcome to the Wyoming Women's Business Center webinar series. Today we are excited to welcome Kim Vincent back for QuickBooks 102, Moving Beyond Your Checkbook, using QuickBooks to track assets and manage your loans and credit cards. I am Jonathan Howdyshell, one of the business counselors at the Wyoming Women's Business Center, and I will be your moderator today. Our speaker today is Kim Vincent. She is the co-founder and COO of the Local Crowd LLC. Kim has worked extensively in both privately held and public service organizations. She has worked for the Wyoming Women's Business Center and the Wyoming Small Business Development Center in counseling and training. Kim has an MBA and a BS in accounting and has extensive experience in assisting small businesses in financial record keeping and reporting systems. Kim has been using QuickBooks, Intuit products for over 20 years and is a QuickBooks Pro Advisor. This webinar is being recorded and will be available on our YouTube channel. Just go to youtube.com and type in Wyoming Women's Business Center. Make sure you subscribe and check out our other webinars. If you have any questions during the presentation, please type them in the chat area and I will ask them for you. Now, without further ado, I present to you Kim Vincent.
Well, thank you, Jonathan. I appreciate the introduction, and I really appreciate everything, the work that you guys do at the Wyoming Women's Business Center, and I'm really honored to be a part of that work. So let's confirm first that you can see my screen okay, and I will just jump right in.
Looks good.
Okay, thank you. So what we want to accomplish today, if I can get my slides to advance, is we really want to kind of dig a little deeper into using QuickBooks to some of the functionality with tracking assets, asset acquisition, recording loans that we may incur in our organization, and then using credit card activities. And I see a lot of folks that work through some of these processes in their business and in their QuickBooks files, and they always have questions about, how come my credit card statement doesn't match the credit card statement that I'm getting from my bank, or I really want my loans I want to be able to go in and look at my balance sheet and see that the loan balance that I say matches the loan balance that the Wyoming Women's Business Center is telling me that I have. So we're going to really focus on those elements of your balance sheet and using QuickBooks to help you track those things. We're going to talk a little bit about the Wyoming Women's Business Center. I always like to put a plug in there for who we are and what we do and the impact that we can have on micro enterprises around the state. And then we're going to dive into actually navigating QuickBooks with my goal is finding tools that you can use to really maximize your accounting time. I know we're not always going to minimize your frustration, but in the long run you have to be able to have a tool where you can real time look at it and understand your business profitability and the business net worth. And we will have time hopefully at the end for questions, and we'll move on from there. So for those of you that have used the services of the Wyoming Business Center, it's really awesome that we can reach out to folks across the entire state. We do have Women's Business Center in the title, but we are available to help men as well as women with really the focus on creating an alternative to low-paying jobs in Wyoming and helping people that want to start businesses, grow businesses. We provide the business planning services, counseling, there's networking and educational opportunities like this webinar here today. And then the really awesome part of our organization is that we do have access to capital. So we have loan funds that small businesses can take a look at. The first requirement is that you have been turned down by a bank. If you can go by a bank, go to a bank and get financing. That's what we really want you to be able to do. But if you have been denied a loan, then that's when you can come to the Women's Business Center and talk to us about what potential funding tools that we have for you. So just a really quick review of what we covered last time, because I'm going to assume that we're going to be at a point where we know how to navigate our checking account. We know how to enter transactions into our checking account. But last time we really thought about, do you really need a program like QuickBooks to keep your financial story current and make reports accessible to your stakeholders? I mean, that's a question that you need to answer in terms of the benefit of investing in learning this type of program in the long run can really save you time, but it's not going to be something that's fairly quick out of the starting gate. Can you accomplish this with a simple transactions list? Last time we showed you some options for just using a real simple spreadsheet and not having to use a program like QuickBooks. Or maybe you do need to transform the way that you're accounting for the financial activities in your business. And is QuickBooks really the quick way to do this? The takeaway that we wanted with the last one is really finding a way for you to process a transaction one time, so that once you touch that piece of paper, you record that activity, whatever it is. It's going to be some type of financial activity. It's going to have financial implications, and you put that piece of paper away, but now that data is stored in a place where you can recover it and look at it and report on it and understand it and dig into the detail if you need to, without having to seek it out in that big pile of paper behind your desk. So I know that we all struggle with this, in terms of really making the most efficient use of our space and our time. And I think this is a tool that can help a lot of businesses once you get over the hurdle of being intimidated. If you think it's going to be too complicated, it really is in the long run worth that little bit of extra time in terms of learning some of the functionality. So today we want to talk about using QuickBooks to track assets and loans and credit cards. So the Women's Business Center does have a micro program, and we do have a pretty big portfolio of loans, and we're always working with our clients to try to get them to understand how to track their loans and the payments and how you can expense the interest. So that's why I think we really focused on this for this QuickBooks 102, is we thought it could benefit some of our loan clients. In the end, we're just trying to create a really manageable process for you for accurately reporting your financial activities. So beyond the checkbook, what does this mean? So I want you to be able to have some really simple steps for, if I'm going to buy an asset for my business, and this is going beyond supplies, this is going beyond my typical operating expenses, but I want to be able to post asset purchases, and I have some options for how I'm going to make that investment. I could either be spending cash, and I need to be able to post that asset purchase. I could be using loan proceeds, and I want to be able to post that purchase and post the loan as a liability, or I could be using credit cards. And I see a lot of people that will make credit card purchases, and I mean it's a valid way to capitalize your purchases and capitalize startup costs, is putting it on a credit card. I'm not encouraging people to really totally rely on credit cards, but it's a great way to, as you're making purchases and you're getting to use somebody else's money for 30 days, you are going to record those purchases as expenses, show that accrued liability on a credit card balance in QuickBooks, and then when you make the payment, you show that payment that reduces the balance that you have outstanding with that credit card account. And a lot of people aren't quite sure how to do that. So when they make the payment, they post the payment as a credit card expense, and you'll see, I'll see profit and loss statements that shows credit card charges. And I mean, that's one way to do it, but you really lose the detail of what's included in all of those credit card charges. So we want to be able to categorize those things correctly. It's really important that you are able to post your loan payments and credit card balances so that you can match the statements that you're getting from your funding organizations. If you're getting a credit card statement, you want to be able to go into QuickBooks and show that your statement balance due matches what they say is due. And I'll show you some really easy tools to work through that. And then we want to be recognizing our interest expenses from the current portion of loan payments. So if we are posting loan payments, there is going to be part of that payment that's interest and part of that that's going to be principal. So what are the tools that we can use to categorize the portion of the payment that's going to be more of an operating expense like the interest piece? So just like last time, we're going to go ahead and I'm going to dive into QuickBooks from here. I mean, this is our little QuickBooks map that we used before. We've set up our company and we've been recording a lot of transactions, and today we're going to look at transactions that really reflect asset acquisitions, if we were to take out a loan for purchases, if we're doing credit card purchases. That's what we're going to dive into right now. So I need to go to, can you see a balance sheet right now on the screen? I'm going to take your silence as as affirmation that you can. So what we want to do is we're in Larry's Landscaping and Garden Supply. It's a service company. It's got a really funky date. It's dated out there in 2018, but it is a sample company that's available in QuickBooks. And if you have QuickBooks, this is going to be a sample that's available to anybody that has QuickBooks on their computer. So when we look at the balance sheet for Larry, he has current assets, he has a checking account, he has receivables, he has other current assets, and then he has, down here, he has a thing called fixed assets. And he has, right now he has a truck. So at some point in time, Larry bought a truck and he put it on, he might have put it on a bank loan. It's not really clear from this how the purchase occurred, but he's putting it on at its purchase value, the original purchase, and then every year he depreciates a little bit of the cost of that truck. So that's where you see the negative accumulated depreciation here. So the net value of that truck right now is $12,000. And the really nice piece of this is that once you put an asset into QuickBooks like this, you do put it at the original purchase price, and every year you're going to recognize depreciation against that asset, which is it's a non-cash expense, but it reduces your income by whatever amount that you're able to add to the depreciation expense. So let's say that Larry wants to buy a computer, and he's going to put some office equipment into place. And so there's a couple ways that we can do this. Let's say that I think I created, maybe I didn't, maybe it went away. So we have this new account called Office Equipment. And what we want to do is, I'm going to show you 3 ways to actually buy this office equipment and correctly record that payment. So in Office Equipment, we can do it, we're going to go down here to Account, and we're going to create a new account, and we're going to make it a fixed asset, and we're going to call it Computer. And this could be any type of asset you want, and we're going to make it a sub-account of our awesome Office Equipment, and we're going to save and close. Okay, now first thing I'm going to do, let's say that I want to pay cash for the computer. If I'm just going to write a check for the computer, I'm going to go into my checking account, and I'm going to go to our local computer store, and I'm going to pay $650 for this computer, and I'm going to record it as a computer because I set up that account as a fixed right there. And what I just did, I didn't want to put like Best Buy or anybody big, and I don't know the name of a local, I know we have a local computer store here, but so what I just did was I wrote a check. So I'm reducing my available balance in my checking account. We're going to quick add. And I just took that money out of my checking, but I left it on my balance sheet as an asset. So it goes out of cash and becomes a fixed asset known as a computer. So that's one way to do it. So let's go back to, I'm going to go back to that list and look at that computer. And there's where I created it. Now let's say that I actually, I didn't buy it for checking, buy it from checking, but I put it on my credit card. So I'm going to go in and I'm going to add this to my credit card balance. I'm not going to do it from this window though. Hold on just a sec. Okay. So I just really, in effect, deleted the check. But we're going to go in and add this office equipment, and we're going to add it as a credit card. Once it recognizes a type of account, it's kind of hard to change what you want to use it as. So I'm going to go into, put it here. I'm going to actually make a charge of $650, and I'm going to do it against a local computer store, and I'm going to add my office computer this way. So what I just did was instead of paying cash out of my checking account, I increase my liability, and I also increase the asset side of my balance sheet. Now when I go and make a payment on this credit card, and I'm going to start paying off my computer, I'm going to make 10 payments of $65 a month, and I'm just going to make that out of my checking account at that point. And it's going to go, my payee is going to be whoever my credit card company is. So this is credit card. Now I think my balance is $585 for this purchase. And then I get my statement from the credit card company, and oh look, they did charge me some interest. So I need to go in and add $5 in interest, and I can expense that out. Interest, those are finance charges. And right here I'm going to say, okay, so now the bank is telling me that I think QuickBooks is saying I have $590 that I have on this credit card, and I think that I look at my statement and I just like to put this little note in the memo field so that when I make a transaction like that, and I've gone in and I've received my statement, I made the purchase, I incur some finance charges, I make a payment, and at the end of that process, yep, I look at my credit card statement, and this ties to what the bank is telling me. So so we could purchase in cash, we could purchase as on our credit card, or we could take out a loan. And let's say that we're going to go to the Women's Business Center, we're going to buy a bunch of equipment, and we're going to, I'm going to create a new account, and I'm going to make it a loan, and I'm going to call it the WWBC Office Equipment Loan. And I'm going to save and close it. There's a lot you can do here in terms of putting descriptions in. We're going to make this a long-term liability because it's going to extend beyond a year. Save and close. All right, so now I'm going to buy equipment, and I'm actually going to put some money in the bank. This is going to first go into my checking account. And let's say that I took out a loan for $10,000. I don't want to do that much. $5,000, and I'm going to deposit it into checking. And it's going to be the WWBC that loans me the money. and now the money's going to go into checking. I haven't spent it yet, but I'm going to make that deposit in my checking account, and I've just added that liability to my balance sheet. I hope. So right down here, I added the office equipment loan. So up here you can see where I put the $650 right at the top of this. There's my computer that I originally bought for $650 on my credit card. And here's the credit card. So it's all balancing out. The $650 and this. Then I added the equipment loan for $5,000, but I haven't spent that yet. So now I've put this loan into QuickBooks, and I want to show you what happens when I make payments to that loan. So to do that, though, I want to talk to you a little bit about loan amortization. So when you have a loan, and when you get a loan from the Women's Business Center or from your bank or wherever it is, we're going to set this up, and it's going to tell us in advance that when we make a payment, and I could just, this is really an awesome tool, but it'll tell me in advance if I borrowed $5,000 on July 1st, and I'm going to do some purchasing of equipment, then I'm scheduled to pay $97 as of August 1st. Part of that is principal and part of that is interest. So we want to keep in mind, and this is just based on the August 1st date. If there's some variation in when you make the payment, then you have to go back and ask your bank, or they can give you an amortization schedule after the fact. Once you've started making payments, they'll always be able to show you what your ending balance is right here. This is just the calculated ending balance based on if you made every payment on the 1st of the month. This is how much you'd owe when the next payment's due. And you want QuickBooks to show this amount. You want QuickBooks to show, oh, okay, I owe $49.29.25. And the way that we're going to get to that is we're going to show a payment of $97.83, and we're going to prorate that between our principal and interest. So this is a tool that's available. If you have a loan, your bank can give you the amortization table, but it lets you know in advance what the payments should look like, how much of it's going to go to principal, and how much of it's going to go to interest. A lot of times what folks will do, they make the payment, it comes out of their checking account, and they show it as loan payment, and they try to expense the whole thing. And we don't want you doing that. We just want you to be able to expense the interest piece as one of your operating expenses, but then you're going to take away the principal piece. And it's going to impact your balance sheet, but it's not going to impact your profit and loss statement. So let me figure out how to get back to, I'm going to go to the QuickBooks piece. Hopefully that comes right in. Okay, so now that we've set up our loan, and we show this balance of $5,000, and now we're going to spend some of that money. The money's sitting in our checking account, and we're going to make a purchase of some equipment. So we go into our checking account, and I love the fact that you can click anywhere in here and get a lot of detail. If you see something you don't understand, I'm in the balance sheet, and I can just click and say, whoa, what is this negative number, or what is this $650 computer? It pops me into the detail. I can click on this detail, and it pops me into the actual charge. And sometimes it'll take you into the actual register. So we're going to go into our checking account, and we're going to write a check for that computer, and we're going to set up the asset right now, and we're going to spend some of that $5,000. Here's where it got deposited into my account, the $5,000. So we're going to write a check to our local computer store. We're buying $5,000, or let's say we buy $4,000 worth of equipment. Now the liability has already been set up when we made this deposit of the money, the loan proceeds, into our checking account. And this $4,000 spending is going to reduce what we have in our checking account. It doesn't change the amount we have for the liability. It's just we're going to add more office equipment. So if we go to our balance sheet and we do a refresh, now we have the $4,000 piece of equipment, we have the $650 piece of equipment. It's, our checking's gone down by the amount that we spent, and our liability right here for the equipment is still at $5,000. So now the first month is passed. We've accurately recorded the purchase of the equipment, and now we want to be able to go in and just make a payment. And make a payment so that our long-term liability is accurately reflected. It's going to reflect the same amount that the Women's Business Center thinks that we owe them. So we'll just go back into our checking account, and on this is so weird working in 2018. We're going to write a check, and we're going to write it to the WWBC, and we're going to write a check for $97.83. Okay. Now your inclination is to just move all of that against the loan, but we don't want to do that because we want to expense part of it. So what we're going to do to this payment, this $97 payment, is just break that into two things. We're going to show part of it as the long-term liability piece, so we're going to pay $70.75 against the principal. So this is the principal portion. This is not, my O's aren't. And then this down here is going to be the interest. The interest on the loans. And it defaults. Once I tell it I'm going to pay $97.83 and I say $70.75 is the principal portion, it says, oh, then you must be you have $27 you still have to account for. And you could break it up into multiple categories. Now, let's say that this office equipment was to a specific project, and we wanted to be able to class it for that type of project. Over here is you have to go into the split window when you really want to work with classes. And this is a really awesome tool we talked a little bit about last time. When you have, like for the Women's Business Center, we have a lot of different grants, and we're making supply purchases, and we have personnel payroll pieces that all get allocated to a variety of classes. I mean, we probably have 20 different classes, so we could create a P&L, a profit and loss statement, and we would be able to break it out by all the different classes. So here's our payment of $97.83, and when we look at our balance sheet, it has, drum roll, we have to date it. Because of that transaction was dated at the end of the month, we need to date this for the transaction of 12/31. So here we go. At the end of the year, we're accurately reporting what our equipment loan is. And this is applicable to any type of loan. So that when I look at this, and at the end of the year, I turn all of this information over to my accountant, I know that my credit card balance is accurate. I know that all my loan amounts tie to that third-party source, which is really important for an accountant to be able to look at your number and look at somebody else saying, yes, that really is what you owe, because they can, they will look for confirmation from banks and from credit card statements. So as you're going along through the year, you want to be able to make sure at the end of, whenever you get a statement, just come in, you're going to be reconciling your statements, your credit card statements and your loan statements with what QuickBooks has. So it may be that you have to accrue a little bit of interest in your credit card. It could be that you have to make an adjustment in the loan that you recognized on your on this loan right here, because let's see if I can, I may have waited a couple days to make this payment, so my interest expense could potentially be higher and the actual principal portion would be lower. So I can tie to what's going on in the real world. I want to show you another way that you could make a payment. Let's say I go through the month and I really don't want to record every credit card transaction. So I'm accruing some liabilities and I get my credit card statement and I pay it off at the end of every month. So when I do that, I could actually just be working from my checking. I can go into my checking and make that credit card payment and just show it as, I don't know who my credit card company is, but let's say I had a bill for $1,200 from my credit card company. And I'm not going to go in, I didn't accrue all of those different expenses in my credit card liability because I know I'm going to pay it off at the end of the month. This is where I can go in and actually split out that $1,200 that I'm going to pay out of my checking and recognize all of the expenses I can break out each class, each expense. So I'm going to total $1,200, and then I'm really making this very, very simple. But so now what I effectively did was I did record all of those credit card charges by the appropriate expense category when I make the payment. So that's another way to do it, just rather than saying, oh, here's $1,200 I paid to my credit card company. You could put that in there when you're reconciling, and then you could go back in later and add the detail from what all the charges broke down to. Or you could just put it into the credit card liability piece, and then once you make the payment, this payment here points to the credit card liability like we did before, and not to the actual expense categories. So we can buy assets using cash, and in which case we're increasing our fixed assets, but we're reducing our bank assets. We can buy an asset with if we want to do it on our credit card, in which case we're increasing our fixed asset and increasing our credit card liability. And again, these are all balancing, right? Or we could purchase equipment or a fixed asset with a loan, in which case the fixed asset category goes up and the loan liability goes up. And again, we're balancing it out on our balance sheet. So are there questions in terms of, am I going too fast, or are you able to kind of keep up with what the transactions look like for you? I think, a really important piece of this is that whatever you have some kind of statement that you're trying to point to and tie to and get the necessary detail, whether it's a credit card statement or a loan amortization scheduled. And then at the end of the year, when you're getting ready to do your tax prep, you're always making sure that your books are tying to these balances. And there's some really pretty straightforward steps that you could take at the end of the year to make sure that happens, so that, I goofed up and I added too much on the principal side, and I need to add a little bit more on the interest side, because when I look at your balance sheet at the end of the year, I want to be able to, I'll say to you, are all of these reconciled, and are they tying to a statement that is reporting accurate balances? Because you want to really be able to maximize all those expenses that you can take in the current year, and your interest and the financing charges that you're paying are going to be one of those recognizable expenses. So, Jonathan, do you see any questions coming in? Is there something that I could show people again, or use a different approach to explain something?
You know, I don't see any questions coming through, and I'm following you on everything you're doing, and it looks great so far. So
Okay. All right. So let me. I'm going to close this out. All right. Okay, so there is sometimes, I mean, I love balance sheets, I really do, because I think it's a way for you to go in and a lot of, you know, if we're unincorporated, you probably haven't had, you know, when you do your Schedule C, you're not required to report your balance sheet to the IRS. So most people don't do it, but I think when you're going through the tax prep piece, okay, I need to go back to this. I'm having problems getting back to the screen I want to be at. So I know what I have to do. I've got to reduce. Huh. I can't get my, I can't, hold on just a sec. Okay, there we go. All right. So we talked about the fixed assets on the balance sheet. These are the tools that you can use. So you know, been busy recording all of these transactions, and these concepts could apply to any type of purchase and any type of liability. But what we focused on was really looking at, okay, I'm adding some fixed assets on my balance sheet. I need to be able to reconcile it to the loan amortization scheduled, and then I need to be able to reconcile it to my credit card statements. And what I'm going to do then, you know, we're going through this cycle where we have all of these are, you know, this is what you're doing on a daily basis, entering all those transactions. On a weekly and monthly basis, you're going back, you're going to be reconciling all the transactions to these third-party statements. And then you want to be able to report. And if only to yourself, you want to be able to look at this. At the end of every month, you want to be able to, because this is really, you're going to be looking at, I inadvertently closed that.
Kim, I have a question. How often should you pull a balance sheet?
Well, what I do is, I mean, a balance sheet is like a click of a button, but what I do is I'm looking at my balance sheet probably monthly. So I've gone in, I've reconciled my checking, I've reconciled, and when I say I'm looking at my balance sheet, I'm really sometimes navigating it this way. So I'm looking at my accounts as the chart of accounts in the list, and I'm looking at my receivables, and I'm looking at these numbers, and I'm saying, well, I don't think that number's right. Or I'm looking down here in a current liability and I'm seeing a negative, you know, so I want to make sure I'm going in regularly and just looking at this list. So you could do it in the format in the presentation of a balance sheet. This is the same thing. This is the list where you can actually, you know, go in and, wow, I have sales tax of $2,000 because these are cash flow issues for you. You know, any of these liabilities are things that need to be paid. And so you want to be able to know what's coming down the pipe in terms of who's going to be demanding payment from you. So you could look at it, I mean, you could pull a formal balance sheet, and then I like to look at it to just go in and see if there's errors. I mean, I like to look at it and say, well, I know that I paid that credit card off. You know, what's this $45 charge? And, oh yeah, that's right. There, you know, I guess I do need to go pay that off. So that's how often I would do it. It just depends on the number of transactions you have and how complex your balance sheet would be. So,
Thank you.
so that, I mean, I think it's, you know, the process that we talked about is, you know, you have these liabilities. You have outstanding balances on the liabilities, and now you need to make payments on the liabilities. And when you make your payments, you want to be able to correctly offset, reduce, whether it's a payroll liability or if it's a credit card liability or if it's an accounts payable. You want that payment to be directed to that account and not just expensed in the current period for that. So I'm going to go back to the profit and loss, because a lot of times when I'm looking at profit and losses, I'll see profit and losses that say, credit card payments. And that's what you could use it as a placeholder, before you do anything else. And I know I have to spend $1,000, but you don't want to be expensing that $1,000 if you've already accrued the liability in your credit card account. Or you want to be able to really provide more expense detail on the categories of what you're spending. So when I look at like a P&L like this, well, there's a couple things that are obviously jumping out at you, is that we have negative expenses. So what's that about? So we can click. You could be doing this weekly, you could be doing it monthly. We click on what's going on, and we can just see that something probably didn't get categorized correctly. And we can go in and make those changes on the spot. Because we don't like to see, if you get a reimbursement for some type of expense, you might show it as, a negative expense. But you really don't like to see, when you're looking at a quick look at your profit and loss, this is like for 2 weeks, you don't want to see negative expenses. You want to be able to go in and say, okay, cool, there's $378 in profit for the first 2 weeks of the month. It's possible that you can go in and compare it to the previous year. That's always a good metric to look at, how I'm doing right now versus how I was doing last year. And you just always have to be checking your work. You always want to have ways to go in and tie out to somebody else's total on what your account should be at. And you always want to just make sure that you put things in place so that if you've made a mistake, it's pretty easy to go in and fix it, recategorize the expense, make it income, or whatever it takes to make this look fairly logical and make this reflect what really happens in your business. Am I paying to, this tells the story, like we talked about in the very first class, is you really want to be able to look at this and understand what's going on. Am I spending too much on payroll? Am I, not charging enough for my deliveries? Do I have postage and handling that's, like a lot of times you could have postage and handling as an income, and you could also have it as an expense down below, so that you charge your customers for the postage and handling, and then you actually pay UPS at the end of the month, and you want to make sure that those two things are a wash. You don't want it to always, to be negative there. So, other questions? So, what I really wanted to do was to show you some really simple steps in terms of posting payments, so that if you're going through and doing purchases, you've accurately categorized that payment. If you're making a cash purchase of equipment, or a credit card purchase, or you're paying on a loan, you have a tool that you know how to correctly expense that payment out. And then we're always coming back to our balance sheet. This is where it gets tricky. I just don't know how to, there we go. We're always coming back to our balance sheet and, looking at it once a month and making sure that all the accounts are accurate. And if you maintain this type of, entering transactions, reconciling transactions, now I'm going to look at a report and I'm going to see, where things are at, what my account balances look like. I'm reviewing, I'm updating, I'm always trying to make it as an accurate representation as possible of what's going in the business. At the end of the year, then, it's really easy. I'm not digging through shoe boxes and I'm not organizing receipts. I have a really good sense of what I spent, where all the money went, and what sort of assets or value and net worth I created in the business. And that's what you're always going to be looking at with your balance sheet, is what is the net worth of all this effort that I'm putting into to my business. So that's what I have. It looks like we've used 45 minutes, so I would really entertain any questions that folks have. I mean, our next session, we're going to go into, well, this kind of wraps up with today's thoughts about, you want it to be real time. I know that I'm giving you another task list to work through, but I think it's really important because you are the best person to be monitoring what's going on in the financial piece of your business. So you have to find some kind of tool to make it really timely for you and have confidence in what you're looking at to say, oh yeah, I think that's a really good representation. And there may be some really specific industry requirements that you have. So I always encourage people to have an accountant on their team. You can do a lot of the day-to-day stuff, and you can, at the end of the tax year, then you turn everything over to your tax accountant, and hopefully they give you some really good advice on ways that you can maybe tweak what you're doing, or they sometimes have good ideas for depreciating assets and maximizing that expense. And ultimately you have to have some kind of accounting software that's really going to support whatever your reporting needs are. And there's so many ways that you can customize QuickBooks to make that happen for you, because we do want to really maximize the time that you have to spend doing this. And so the next webinar that we're going to do is going to be more of a deep dive into the reporting process, because there's so many things that you can do with regards to getting ticklers about what needs to be paid, and memorize transactions, and if you want to, it would be awesome if you could submit your questions in advance, and we could take a look at specific features that you might want to use and tap into with your QuickBooks. And I think at the end of this there'll be a survey where you can maybe type those comments in for what you'd like to see at the training on June 29th. So that's what I have formally prepared, but I would be happy to answer questions.
Thank you, Kim. At the end of the presentation, I just would like to bring up too the investment that we as business owners take time to do the work that you're suggesting, and do the work in QuickBooks, having it organized, having it ready for your accountant. It will not only save you money, it will make your accountant very happy.
Yeah, that's a pretty fair assessment.
So thank you everyone for joining us. Please make sure to fill out the survey at the end, like Kim said, and if you do have any questions, please add them to the survey in the comments area. Or if you'd like to email us, please feel free to email us at the wwbc@uwyo.edu. The next presentation is QuickBooks. It's displayed on the screen currently right now. Make sure you get registered. And if you have any questions, please feel free to contact us. And thank you so much again, Kim. If there are any other questions, please.
Jonathan, can I add one more thing? Sometimes it's really hard to, if you're more of an experiential learner rather than a visual learner, it's better to just, I could work with folks one-on-one if they do have specific questions and they don't necessarily want to bring them up in the class setting. We could get online and share a screen and take a look at their specific questions with regards to their QuickBooks. And it's a completely, it's a free and confidential service offered by the Women's Business Center. And we love to support our clients that way, to help them fine-tune their QuickBooks. If they do have questions, we would welcome that as well.